Hey, welcome back. Hope you are as excited about this as I am. I think you're really going to like what this looks like. It's always eye-opening for me to see how the math just maths. It just works. It does its thing. Let me go into this and show you kind of what we're talking about here. So starting at a $5 million policy, and so this is a 46, 47-year-old, right? On a $5 million policy, if we were going to do a 10-year term insurance policy for a $5 million death benefit, the annual premium, $6,000 a year, $500 a month. 20-year policy, a 20-year term insurance policy for $5 million, $10,000 a year. Or a 30-year policy for $5 million, almost $20,000 a year. Now, term insurance is just death benefit only. There's no cash value accumulation. There's no additional features and benefits that come along with that. And I did a video in the YouTube channel that is why term insurance is a scam, basically. And less than 2% of all term insurance policies have ever paid a death claim. Of all the policies that have ever been written, there was a University of Penn State study. It's a fairly old study, but the Penn State study said that less than 2% of all insurance policies have never paid a claim, either because the people are still alive, the insured's still alive after the 10, 20, or 30 years, or they just cancel the policy because they no longer think they need the insurance coverage. Unless you're covering a specific need for a specific window of time, I don't think that's an option to select. So then it becomes to permanent options. And so when you talk about permanent insurance, you have indexed universal life, you have whole life, and then you've got variable life. But let's focus on indexed universal life and whole life, because those are the two that probably would make the most sense in this example. So from a self-pay, meaning you're going to pay the premiums, in order to match our premium finance design, and our premium finance design, which I'll get into here in a second, not only covers your death benefit, but also projects you taking out $205,000 a year. On the $5 million policy, projects you taking out $205,000 a year, starting in year 16 for the rest of your life. So in order to match that distribution of $205,000 a year of tax-free distributions starting 16 years and on, we need to put in, or we need to have you put in $164,000 a year into your policy for 10 years. $1.6 million of your money. And remember, those are after-tax premiums. You have to earn the money. We had this discussion, earn the money, pay the tax to then have the money for the premium payment, in order to fund it for $164,000 a year on a $5 million policy. And so that would create an opportunity for you to get $205,000 a year, but I'm sure you make a lot of money, you're doing very well, you could probably afford the $164,000 a year. The question is, do you want to afford the $164,000 a year? And if you did whole life, even more, nearly $250,000 a year. So $2.5 million of contributions over 10 years just to get anywhere close. And this is not even $205,000. It only gets you to $159,000 of tax-free distributions. So here's the premium finance model. And this is what I think makes the most sense. We still got to talk about all the risks involved with the premium finance structure. And I'll hit that up real quick. So the considerations in a premium finance design are interest rate risk, which we will talk about at length, performance risk, which is the policy going to perform as illustrated, exit strategy risk, meaning how are we going to potentially pay the bank loan off, and we'll show you that, and then collateral risk if the loan were to default. But the only reason why the loan were to default is if we bite off more than we can chew and we don't design the policy the right way. But assuming we do, and I think we will, because this is what we do, then we're looking at a $5 million policy, you paying $30,000 a year out of pocket. We're going to pay the loan off in year 15. That's our exit strategy. And we're going to generate $205,000 a year to do that. The added component of premium finance means we're going to have to pledge some additional collateral. And the peak collateral is projected to be about $260,000 in the second year on the $5 million policy. But I also ran a $7.5 million policy and a $10 million policy for you, just so you could see the difference. Still paying $30,000 a year, but the larger the death benefit, the more premium can go in. The more premium that can go in, the more cash value. The more cash value, the more potential growth, the more potential tax-free distributions. But the caveat to more and bigger is also that the loan is going to be bigger and the collateral is also going to be potentially bigger. But that's why we have to figure out what makes the most sense. So let me show you the $5 million design, and let's walk through that real quick. So we've got a death benefit starting at $5 million. Column 3 is going to be the policy premiums, the max funded policy premiums, to fill the bucket up of cash value inside of the policy to its limit every single year for 10 years. But here you can see we're going to borrow the premiums in this column. We're going to borrow the money from the bank. The bank is going to apply an interest rate charge, which is what banks do, right? And the question is, do you want to pay all of that interest out of pocket, or do you want to defer some of that interest out of pocket? That's a choice that you have. Based on the discussion we had, I'm going to show you paying $30,000 a year. That's what we kind of settled on. You said it could be more, but let's focus on $30,000 a year for 10 years as an out-of-pocket payment. So if the bank is loaning you the premium and they're technically loaning you the interest every year, so we're going to add those two together. We're going to add the premium plus the interest. We're going to subtract the $30,000 payment that you're making. And at the end of the year, in year 1, we're going to have a loan balance of $380,000. Now, when banks loan money, they want two things. They want interest and they want collateral. Well, the first piece of collateral that the bank is going to take is what's called the cash surrender value of the policy. And in this particular carrier, the year 1 projected cash surrender value is $126,000. So 380, which is the outstanding loan balance, minus the 126 cash surrender value, the first position of collateral, leaves a gap of $254,000. So premium financing, the additional complexity that it brings to the table is that you're going to have to pledge for 12 months $254,000. Day 1, you have to pledge $254,000. That could be cash equivalents, marketable securities, or other assets that you may have that you're not planning on selling that you might want to pledge as collateral here. And in the second year, they're going to loan another $388, the bank is, plus they're going to loan more interest. You're going to make another $30,000 payment, and your end of the year loan balance is projected to be $777,000. The cash value is $517,000. Subtract the loan from the cash value, leaves a gap of $260,000. So in this example, you would have increased your collateral pledge by, call it $6,000. Not quite $6,000, but $6,000 to get it from $254 up to $260. Wash, rinse, repeat every year. And it's all based on what interest rates do, and it's all based off of how the policy performs. And we can talk about the historical performance of this policy. Is it 6.6? Is it more? Is it less? How will this perform over time? Let's have that discussion. But then in year 3, your collateral is projected to go down, 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 down. And ultimately in the 7th year, you'll see the outstanding loan balance is $3.5 million, $3.53, and the cash surrender value is $3.59. So now this is greater than the outstanding loan balance, and so there's no additional collateral required to be pledged. But to keep the policy going and to keep it supercharged, we still have you putting in another couple years of $30,000 and then exiting the loan. We're going to take a distribution from the policy, not from your outside assets, which we could do, not because of your death, which we could also do, but you have to die in order for that one to happen. And this assumption is you don't die, at least not anytime soon, you live. So we take a distribution from the policy to then retire the loan and exit the loan. By the way, this loan, no personal guarantee, non-recourse. The only exposure you have is column 14, and the collateral that you're pledging is your only exposure. This doesn't show up on your credit report, doesn't show up on your FICO report, doesn't show up doesn't impact your credit worthiness. And once the loan is retired in the 15th year, this is where we illustrate $200,000 a year of tax-free distributions coming out. And it's not just for a couple of years. We illustrate the $205,000 a year of tax-free distributions coming out every year. And let's just say your life expectancy was age 92. Not only would you have taken $205,000 worth of distributions from this design from your age 63 to 92, which is 30 years of distributions of $200,000 a year, which is $6 million of distributions income tax free, but it would also have a death benefit for your beneficiaries of another $6.2 million. Now, this $200,000 is a tax-free distribution. That's probably the equivalent of closer to $300,000 or $350,000 pre-tax to get to a $200,000. Think about the supplement to your retirement that can provide at this age, right? And that's what we're talking about here. It's an alternative asset class. It's an alternative way to build some tax-free dollars. Think of it like a Roth IRA on steroids. Now, this is the $5 million design, and I want you to focus on two things. I want you to focus on the distribution of 205, and I want you to focus on the collateral. So this is what you have to be comfortable pledging is the collateral, and this is the goal of what we're trying to accomplish, which is the tax-free distributions. But when I go to now a $7.5 million death benefit from a $5 million death benefit, everything is the same except for like your out-of-pocket payment is still $30,000. What's different is I've increased the size of the policy, which increases the premiums, which increases the loan, which increases the interest rate. And by keeping your payment the same at $30,000, the math means that the gap has gotten bigger. So now you have to pledge more collateral. $396,000 in year one, projected peak collateral of about $423, $425, still out of the collateral game by year 7 or 8. But now taking $287,000 of tax-free distributions as opposed to what we were illustrating prior to $205,000 of distributions. So again, comes down to, do you feel comfortable with this amount of collateral pledge? Or if you had the ability, could you pay more out of pocket in any given year? Because remember, bank is providing the premium, plus the bank is providing the interest, and we're subtracting your out-of-pocket payment. So if you increase your out-of-pocket payment, it will then reduce the collateral that you have to pledge. This is a $7.5 million design, and let me take you to the $10 million design. So we went from $205,000 of tax-free distributions to $287,000 of tax-free distributions to $368,000 of tax-free distributions. But again, the difference is still putting $30,000 a year for 10 years in. The question is, how much of a collateral pledge do you want to make? So think about it. I'm excited about this for you. So I'm indifferent to which one you want to choose, whether it's the 5, 7, or $10 million design. I just want to make sure we are within your comfort range of projected collateral, and we are achieving what you want to achieve from a tax-free distribution standpoint. So let's have this discussion. I wanted to get this in your hands. Hope you like it. Talk to you soon.